Live from Sydney, I'm Paul Allen, and this is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, we've got treasuries rallying after private sector data signal a cooling US labour market and bolstering bets on a Fed rate cut. AI bubble fears play out in Tokyo, with investors rotating out of tech shares. SoftBank plunging after it sold its entire stake in Nvidia to fund its ambitions. And we'll ask well-known Wall Street bull Ed Yardeni whether he sees any risk of the AI bubble bursting anytime soon, or if he's holding on to his targets. Also, we're going to speak exclusively to the MD and CEO of one of India's largest power companies about how the energy-hungry AI revolution is impacting its business plans. And also ahead, we are live at the Singapore FinTech Festival to talk about how AI is changing the banking industry with Citi Institute's Ronit Ghose. Let's take a look at Asian markets, with the US moving closer to ending its government shutdown. Traders are awaiting a deluge of delayed official economic data once that shutdown is eventually ended. In the meantime, though, the focus is on private data. And we had the latest ADP numbers showing more job losses in October, and that is adding to bets for a Fed rate cut before the end of the year. Right, let's get some perspective now from Ed Yardeni, our president at Yardeni Research. And Ed, as I mentioned there, we do have a lack of data at the moment, so we're relying on private reads. And those ADP numbers supporting some of the jobs data that we had out last week as well, suggesting something pretty similar. A lot of jobs getting shed. But really, depending on which Fed speaker you're listening to at any moment, it's either jobs that are most important or sticky inflation that's most important. So from your perspective, what's the greater force at the moment?
Well, I think it is a bit of a toss-up. I think Fed officials aren't quite sure what they want to do, but my inclination is to believe that they'll pass on a December rate cut, that there will be another pause. They'll reconsider at the beginning of next year. As Fed Chair Jerome Powell recently said, over the past year, they've already lowered the federal funds rate by 150 basis points. And maybe it's time to just give it a rest and see how it all plays out in the economy, and also wait for some better data to understand where the economy actually is. But right now, I think they still need to be concerned about inflation. And obviously, in the labor market, there's some issues, but I'm not sure that those issues can be solved by lowering interest rates.
So you mentioned that you see a December rate cut coming, but are there some risks to that expectation as well? Because, as you say, we've been a bit data poor recently. Is the market prepared for the risk of a pause in December, and maybe that pause being extended for some time?
I think it wouldn't be much of a surprise, because I think Fed Chair Powell already signaled that in his press conference a couple of weeks ago. And the market did sell off on that, but then regain its footing, mostly because the earnings story is still very good. There's a lot of concerns about the economy, but I think the economy is actually has proven and will continue to prove remarkably resilient. And we see that in earnings. They say that the stock market is not the economy, but earnings are the economy. So the stock market is very much influenced by what's going on in the economy, as reflected in earnings. And the earnings picture in the first quarter was surprisingly good, same in the second quarter. And now we're getting kind of the tail end of the third quarter earnings reports, and they also look amazingly good. Instead of a 6.5% increase year over year in earnings, it's coming in at 14% on a year over year basis. That's what's really driving the market.
Yeah, that's an important point to remember, that things aren't bad, and normally if the Fed's cutting rates, you would say, well, the economy looks as if it's in need of support. But you point out There's already been quite a lot of easing so far. Does the US economy look like it needs support?
Not to me. As a matter of fact, last year when the Fed started cutting rates, I said that might be a mistake. Because the economy was stronger than they were thinking. The labor market at the time certainly looked stronger than they were thinking, and that proved to be right. But they went ahead. They didn't listen to me. They cut the Fed funds rate by 100 basis points for September through December of last year. And guess what? The bond yield went the other way. Bond yields rose 100 basis points, so they more than offsetting the easing of the federal funds rate. And it kind of looks like the same thing is happening right now. They cut by 25 basis points, and then 25 again. So we've got 50 basis points here in September, October, and yet the bond yield is kind of sticky around 4%. Mortgages are kind of sticky around 6.5%. So the Fed's got to appreciate that the Fed funds rate, while they can control that, they can't control the rest of the yield curve, and the rest of the yield curve is sort of saying no mas. Let's not go. We don't really need it.
Yeah, and where do you feel the Fed funds rate is positioned vis-a-vis the neutral rate? Do you think we're getting close?
Well, you're asking the wrong guy, because I think the neutral rate is an illusion. It's maybe even a delusion. There is no such thing. If we can't measure it, and if we could measure it, I think everybody agrees it wouldn't necessarily be fixed. It's not like some constant in mathematics. I think we only really know it after the fact, and what seems to be factually true is the labor market is tight, even with its problems. The unemployment rate is 4.3%. That's the last reading. And inflation is still 100 basis points above the 2% inflation target. But it probably will drop to 2% over the next 6 months once the tariff shock is over. So we're kind of at nirvana. We're kind of where we should be, which leads me to conclude then, so why are we lowering interest rates? Why is the Fed lowering interest rates, and why is the bond market resisting it? So I think the bond yield at 4.5%, the federal funds rate at 3.5% to 4% is where the economy continues to thrive.
All right, so you're painting a picture of relentless optimism here, and the saying goes that the only thing that kills bull markets is a recession. Yeah. So, from what you're saying, we're nowhere near close to one of those. So, that in mind, you've updated your price target for the S&P by year end. Can you unpack that a little bit more for us?
Yeah, I'm looking for the S&P 500 to get to 7,000 by the end of the year. It's been a volatile year. I wrote a couple of times that I reserve the right to change my opinion as often as the president changes his mind about tariffs and other matters. I did start out the year at 7,000. Then with the tariffs, I gave in some, but I remained bullish relative to where the market was, and I'm back at 7,000. Well, I mean, it's only 2% away. It's a day or two away in terms of getting there. I'm using 7,700 by the end of next year. That will be a 10% increase. So I think it's still very much a bull market. And look, I think the optimistic view, so far so good. I started out back in 2020 arguing that this decade could turn out to be the roaring 2020s. And so far so good. And guess what? I don't even think it's going to end badly the way the 1920s ended.
I was about to say, let's hope it's not followed by the 2030s mirroring the 1930s. But let's move on from that idea. We've also got reason to have a little bit of optimism as well, with the US government apparently on the cusp of reopening. Would you expect to see any meaningful bounce to asset prices off the back of that?
I think there already has been. I think the market had rebounded somewhat on Friday. It was still a down day, and then it had a very good Monday on the perception that Congress would open the government, and we seem to be on course for that. So I think the market's already pretty much discounted that. I think the market right now is kind of wondering what happens if the Supreme Court later this year or early next year determines that Trump's tariffs are unconstitutional. Then what happens? That could be a messy situation. I guess the administration would have to refund the tariffs, and then the bond market could have an adverse reaction, because right now, if we keep the tariffs in place, the government's going to bring in another $350 billion over on a 12-month basis, and that could disappear, and some of it might have to be refunded if the court rules against the administration, which it very well might. So that will probably happen at the beginning of next year. For now, I think we're sort of in year-end rally mode, Santa Claus mode, and 2-3% increase from here would get us to 7,000, and that would be a great way to end the year.
In the back of my mind, I can hear viewers saying, ask about AI bubble risk, but we're going to get to that in a little while.
Sure.
But first of all, the question around the tariff risk that you were just discussing there, is that part of the reason you've changed and lifted your outlook for the price of gold as well into 2026?
Well, I've never had an opinion on gold because I'm an old-fashioned strategist. I need something to value. I need some income, some dividends, some coupons, but the gold doesn't provide any of that. But when the gold price rose above 2,000 to a new record high last year, I did write that I thought that might be the beginning of a major breakout to the upside, and I thought it was mostly related to a simple fact, and that is Russia invaded Ukraine. The United States froze the international reserves of the Russians, as of the Europeans, and central banks of countries that don't share our views started accumulating gold. So I thought that was basically what was driving it. But along the way, I think another story here is Chinese investors lost a lot of money in the property market. They got whipsawed in the stock market. I think they've kind of stumbled onto gold as a good way to increase their net worth. And so I think that's also driving the price of gold up. When it crossed 3,000 at the beginning of the year, I kind of looked at the charts and I thought I could see this thing getting to 4,000 by the end of the year. And as you know, we got there a few weeks ago. And I'm using 5,000 by the end of next year and 10,000 by the end of the decade, which is where I also see the S&P 500.
10,000 by the end of the decade. I mean, I'm wondering if that part of the reason for that is that, gold is priced in US dollars. We're seeing quite a lot of dollar weakness at the moment. And, Stephen Jen of the dollar smile theory has been the latest to weigh in on this. He sees the trend for the US weak and getting weaker. What's your view for the greenback?
Well, I guess I continue to be a contrarian. I don't try to be a contrary just to be contrary, but that seems to be where I've been heading. And I think gold had just a correction, kind of a 8 to 10% correction. A lot of people are using DXY, which is the dollar index, and it's about 57% weighted in the euro. So the DXY is basically the euro. And I don't have any particular reason to get excited about the euro as an alternative to the dollar. But I think what a lot of people are missing is stablecoin. We had in July, the Congress passed and the president signed the Genius Act, as it's called, and it kind of legitimized stablecoins, and the stablecoins are just digital dollars that are backed by liquid assets, by treasury bills, and I think a lot of them will be in dollars. I think a lot of them will be backed by treasury bills, and I think it'll be used. I think it'll be one of the reasons that the dollar will actually be surprisingly strong. Already, a lot of emerging markets are latching on to stablecoin as a good way to deal with the fact that their financial systems just aren't that developed.
All right, Yardeni Research President Ed Yardeni is going to be staying with us, and we're going to take a closer look, as promised, at the possible risks bubbling in the bond market as hyperscalers borrow billions in a race to build out AI infrastructure. Stay with us for that conversation. This is Bloomberg. Big tech has been rushing to sell corporate bonds as a debt-fueled AI investment boom takes off. Amazon, Alphabet, Meta, Microsoft and Oracle have all raised about $93 billion this year, which is more than the previous 3 years combined. Now, this is adding to concerns that firms are indulging in creative accounting, although creditors are still demanding extra yield to fund the AI infrastructure build-out, signalling a bubble has not yet formed. Ed Yardeni of Yardeni Research is back with us, and Ed, it does feel like the question of the zeitgeist at the moment. Are we seeing a bubble in AI or not? What's your view on this?
Well, again, my contrary instincts are coming out on this. it's a good thing that everybody's worried about a bubble. Typically, when we are in a bubble and it finally bursts, nobody really saw it as a bubble, and when it finally burst, they said, "Oh, it was a bubble." In this case, I think a lot of people are comparing it to 1999 when we had a lot of seller financing, a lot of telecommunication equipment companies did seller financing. They raised money in the junk bond market, and so there was a tremendous amount of debt involved. The dot-coms got an initial round of funding. They spent the money on telecommunications equipment to get on the internet, and they bought computers and all that. And of course, there's a lot of demand for IT hardware and software because of the coming Y2K problem. But so when we crossed into the new millennium, IT spending just took a dive, and the whole bubble turned into from the tech bubble to the tech wreck. In the current situation, there are similarities, of course, but there's also a tremendous amount of cash flow that these companies are generating. Some of the data centers are being financed with debt, but to a large extent, it's still being financed with cash flow. And these companies know what they're doing, in my humble opinion. I hope they know what they're doing. I think they've got dashboards that are constantly showing them the extent to which the capacity of their data centers are being used, and they're seeing that there's tremendous demand for these data centers with AI. I'm somewhat skeptical about AI. I don't think it's going to be super intelligent. I think AI is artificial, but it's not intelligent. But what I do think is that it is very useful, and I find myself using it all day as a research assistant. I especially like it when it provides the sources that it uses, because I can always go double check that it's giving me the right numbers and the right conclusion. So I kind of question whether we have a bona fide bubble here.
Yeah. In terms of the parallels with .com, I mean, yes, there was the tech wreck ultimately, but, the internet didn't go anywhere. It's now pretty much at the center of civilization itself. I mean, do you see the same sort of thing perhaps happening with AI? It's like the weak hands get shaken out, the technology remains. But in that context, my question is, who are the weak hands here?
Well, that's a very good question, because the companies that should be the weak hands are the ones that are spending all the money and creating this bubble. And I find it hard to bet against Microsoft, Google, Amazon. Some people are betting against Facebook because Zuckerberg got into that whole metaverse nonsense, and so maybe they see a parallel there. But these companies have been amazing companies. They are called the Magnificent Seven for a reason, all these mega cap companies. And I think they're not going to suddenly fold because they spent too much on data centers. If they're spending too much on data centers, they'll see it on their screens, and they'll cut back on capital spending. And maybe initially the market might take a dive on that. But then they'll realize that, wait a second, if they're cutting back on capital spending, that means that their profits are going to be better and their cash flow will come back, and they'll start buying back shares. So I think there's a lot of differences between now and what happened in 1999, 2000.
Well, the key question is, where does the return on all of this investment come from? Is that something that you give some thought to? When are these technologies going to start making money?
Well, it's a question everybody's been asking, and the answer is they are making money. And that is, if you look at the cloud providers of, especially if you look at Microsoft and Google and Amazon, their cloud revenues are up over 20%. I think they're up collectively 26% on a year-over-year basis. That's a huge growth rate. And they all say a lot of that is AI related. Again, I'm using AI all the time, just doing research, and everybody I talk to is at least looking into AI, and a lot of companies are actually implementing it as an important productivity tool. All that has to be run on the cloud. When I go and talk to Copilot on my cell phone to ask questions about things, that large language model is run on somebody's cloud. So it's I think the answer is they're already generating revenues for the cloud makers. OpenAI is a whole other story. At some point they're going to have to make some money to make good on the money they're throwing around. But when they go public, they're going to be worth a lot of money.
I'm sure there will be a lot of excitement when that day does arrive. But you talk about the productivity gains. I mean, there's a paradox embedded in there, though, isn't there? I mean, it's very helpful tools in terms of productivity, but also a high likelihood that a lot of people are going to get put out of work here. How do you square that circle?
Well, whenever you have major technological revolutions, the initial impact is to certainly create a lot of redundancies in the areas where the technology is having a tremendous impact. But it takes a little while, but people do reinvent themselves, find new skills, and find new jobs. I mean, I guess all these kids who came out of school that thought for sure that if they studied coding, they'd have a great job, are now, a lot of them are out of luck. I don't think that they're going to suddenly conclude they should be plumbers or electricians or, helping to build these data centers. But there are plenty of job openings and opportunities that are actually related to building these data centers and keeping them going. There's a lot of demand for electricity, and we're going to have to build a tremendous amount of infrastructure there. And the other thing is, there's actually labor shortages related to demographic factors on a global basis. So we actually need to increase productivity in order to grow. And we're all kind of becoming like Japan, very slow growth in the labor force, and we need to offset that with productivity.
Ed, we're nearly out of time, but I hope you'd indulge me with a philosophical question and a way to finish. I mean, you mentioned a moment ago you're confident AI won't surpass human intelligence, but can you be absolutely sure? Because that's a view somewhat at odds with a lot of leading scientists and thinkers in this space. I'm thinking people like MIT Professor Max Tegmark or Nick Bostrom. I mean, this is on the cusp of being able to program itself and self-improve.
Yeah, well, again, I view AI as artificial, not intelligent. From what I gather, I don't think it has much of a chance of ever being intelligent, because right now the only reason it sounds so intelligent is because it's kind of like autofill on steroids and speed. It's really, really good at kind of figuring out what makes sense to say next or to write next. But it is prone to hallucinations. It is prone to making mistakes. And when you call it out and say, I think you're wrong about that, it apologizes. It said, oh, you're right. It's very polite. But it's at this point, I don't see that there's a technological innovations that are going to today lead directly into superintelligence.
Okay, Ed, we're out of time, unfortunately, but thanks so much for your time today. That's Ed Yardeni, President at Yardeni Research. Coming up, we're going to get the outlook for India's rupee ahead of today's October inflation numbers. Stay with us for that conversation. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where markets stand. We've got mainland Chinese markets heading off to the lunch break. Elsewhere around the region, we are seeing a bit of strength for the Kospi. It's better by about 0.75% at the moment. Modest gains in Japan. The Nikkei better by about 0.1%. We're seeing oil prices continuing to remain soft, and we've got a slightly stronger yuan as well versus the greenback. Not a lot of movement for the yen, though, still parked at pretty weak levels, just above 154. Now, we want to take a look at SoftBank as well, because SoftBank today slid up to 10% at one point. It's now bouncing back off some of those losses, 6.23% weaker. This is after selling its entire stake in Nvidia. That brought it $5.83 billion. The plan here is to help bankroll other AI investments. So that sale coming despite better than projected quarterly results that included a 4-for-1 one stock split. But it does circle back to that old theme, the old debate about whether all this big spending is going to end up producing commensurate returns. So SoftBank's unloading its whole stake in Nvidia for $5.83 billion, currently off 6%. We're also tracking the open for the Indian rupee. We're standing by tonight for inflation data out of India. That'll come in a few hours' time. Anticipating a bit of weakness there. 0.4% on year. Now, we are well below the tolerance limit for the RBI. This is being driven by falling food prices as well. The RBI has already cut 100 basis points this year. Nothing for the past two meetings, though. The repo rate currently 5.5%. So we've got a very, very weak rupee right now, ahead of that data, 88.6 at the moment. So although ING sees the rupee strengthening in 2026, not only weighed down by US tariffs, but it's so weak now, ING sees it trading as below fair value. Well, let's get more on the rupee ahead of those October inflation readings with Bloomberg Emerging Markets macro strategist Marcus Wang. So, Marcus, against that backdrop I just painted, what's the path of least resistance for the Indian currency here?
Well, I mean, as you pointed out, I think the inflation reading that is about to come out could be actually lowest on record. Of course, this would increase dovish wages for the RBA because the print would be below the 2 to 6% inflation targeting range by the central bank. But bear in mind that even if the rupee weakens, you only weaken the margin because there's a strong belief out there that the Reserve Bank of India will continue to defend the rupee at current levels. Some banks are even calling the 89 per dollar level a line in the sand if you must. And I think the larger market is just waiting, in a sense, for a US-China trade deal. And Trump has kind of alluded to that this week, saying that US and India are actually close to a trade deal. So that is a catalyst that investors are looking out for. And if that does happen, and we see tariffs on India reduced from 50%, which by the way are the highest in the region, reduced significantly, this could be a catalyst for the rupee moving forward.
Marcus, you mentioned the RBI might be tempted to defend the rupee, but why not just cut rates further? What's the RBI waiting for here?
The RBI could, in all instances, cut rates. I think it's not the rupee that is holding it back, but I think it's really its outlook for the Indian economy and whether this deal will actually come true. The Reserve Bank has quite a few arsenals, if you must, to defend the rupee, and currently it is actually using its reserves. By Bloomberg Economics calculates that it has used over $20 billion or so dollars in the 2 months to October to defend the rupee. And it's not just the spot reserves; it's using its forward books to defend the rupee too.
So what is it that's dragging inflation lower at the moment?
Well, I think the big driver is food prices. 1 year ago, food inflation was a big issue in the economy, but that has, decelerated sharply since then. And of course, rebasing of CPI indicators also played a part into it. So the point is that this is a figure that is largely expected by the market. So in the sense that I think the print, even if it comes in at a record low, will not see a huge sell-off in the rupee because the market kind of expects it to come in. It's how the RBI will react after. And I think there's a strong sense again in the market that the RBI will defend the rupee at current levels.
You mentioned weakening food prices here. Are there implications for India's farm sector? Is this something that could potentially need support, and could that have any impact on the currency?
Well, I think food support continues to be a key milestone policy of Indian politics. You're right to say that I think if it continues at current levels, we could see policy come in, support come in, but suffice to say, the main catalyst and markets are focusing on right now would not be that in a sense, because this is a bit of a conditional ifs moving forward. What the market really is honing on is how the US-China trade deal comes through, and if that does come through, that will provide some relief for the RBI, as they won't have to defend the rupee much longer. While for investors, this could actually see a turnaround in the rupee. Some investors are already calling buy the dip in a sense on the rupee at current levels.
All right, Marcus Wang there, our Bloomberg Emerging Markets macro strategist in Singapore. Well, let's stay with India, and deadly blasts in the capitals of both India and Pakistan are raising concern of renewed tensions between the nuclear-armed neighbours. The suicide bomber blew himself up on Tuesday outside a crowded court building in Islamabad, and that followed Monday's car explosion near New Delhi's historic Red Fort. Let's get the Bloomberg government reporter now, Sudi Ranjan Sen. So, Sudi, what kind of reactions have we seen regarding those explosions, and what are the fatalities?
Well, I mean, it's the reactions that we have seen from both capitals are very predictable. At least from what we have seen coming from Pakistan, it's squarely blamed India. To that extent, India has been slightly restrained. Although the reaction that India came out with after Pakistan blamed India has been quite scathing, quite caustic, blaming Pakistan for being, an epicenter of, so to say, terror coming from the foreign ministry. So the war of words, so to say, has already started. However, we have seen the government of India, being very cautious. It's not come out and blame Pakistan yet. It's the statements that we have seen from the government kind of, is reiterating and saying that let the investigations go through and we will let the details that come out of the investigations, we'll make them public. In fact, the defense minister yesterday said that when he was speaking to senior military officials yesterday. So it's a kind of a wait and watch, but reaction from Pakistan predictable, and reaction to that from India also on predictable lines.
So how likely is it that we could see some sort of adverse reaction from either India or Pakistan? What efforts are underway at the moment to cool tensions going forward?
Cooling of tensions going forward, if there is something that's happening on the background, nobody knows. But as what is in front of everybody, the diplomacy part of it, the relations really are not at all well between India and Pakistan. A quick reminder being that India and Pakistan fought a 4-day conflict. I mean, there was a 4-day conflict between the two countries where, it was literally full-scale war at that point of time in May. You had both countries going after the other's civilian and military targets using drones, artillery, and the whole range of works. So it's on the edge. The relationship between the two countries are on the edge.
In the meantime, we do have a state election happening in India in the state of Bihar. We've got exit polls indicating Narendra Modi's alliance leading. Can you give us a sense of the importance of this Bihar result?
Bihar, as a state, it's an eastern state. It's an agrarian state. So a win from Prime Minister and his alliance winning from Bihar very clearly then reiterates that people still consider him as the leader. He's still very popular and this comes in the backdrop, or the background to this is that Prime Minister himself could not lead his party to a complete majority in the last general elections or the federal elections, where his party lost a substantial number of seats and went into an alliance to form the federal government. Winning Bihar elections now, about 6 to 8 months after that, or 9 months after that, will be a stamp of approval to the Prime Minister. It is also a stamp of approval to the policies that the Prime Minister is doing. And on the contrary, if Bihar were to slip out of the hands of the Prime Minister, slip away from the BJP, that could lead to further questions about, is the Prime Minister, does he enjoy the confidence? And what happens within the BJP? So all these questions then come about, and therefore the Bihar election results are very, very important.
Well, Bihar, as you mentioned, are one of the poorer states in India as well. What have been promised to voters there?
So we've seen the opposition that's led by Rahul Gandhi and the regional party, the alliance that is there between the two. Rahul Gandhi, of course, leader of the opposition, leader of the Congress party, the main opposition party in India, has kind of promised jobs. Unemployment is a big issue in Bihar. It's also one of the biggest, it's also a center from where a large number of migrant workers across India come. So economy is going to be a key factor. That's what seems to be a factor that voters are going to, be used to vote when they've gone out and voted in two phases in the last week. That was in the back of the mind. That's what what's the exit polls are kind of showing. And if they were to go and choose the BJP and Prime Minister Modi's alliance, that would give him a stamp of approval again.
All right, Bloomberg government reporter Sudhi Ranjan Sen there. Thanks so much for joining us. Let's take a look at Indian markets. Meanwhile, just ahead of the open, in about 4 minutes' time, the parents of India's top discount broker, Groww, going to start trading in Mumbai today after raising $752 million in its IPO. So we'll bring you more on that in a moment. Let's take a look at how that pre-market session is tracking, though. The Sensex currently ticking higher by about 4/10 of 1%, about half of 1%, let's call it. We've had Goldman Sachs turning overweight on Indian stocks recently, sort of joining HSBC and Societe Generale in their forecast for a rebound on Indian equities. We have seen valuations easing recently, and bonds in India do remain among the most high-yielding in the region. It looks like we're setting up for a positive day. Just on the bottom of your screen there, the Rupee still very weak, might even weaken further following this evening's inflation numbers. Still to come, Tata Power CEO Praveer Sinha is going to be joining us to discuss the opportunities in supplying energy for AI data centres, also as well a potential foray into nuclear energy as well. Much more ahead. This is Bloomberg. All right, markets in India have just opened. Let's take a look at how we're tracking here. We are a little bit better on the Sensex, some modest gains there, better by half of 1%, really echoing what we're seeing across most of the major markets in the Asia Pacific at the moment. We've got the Nifty Bank Index lagging a little bit, still higher by about 1/3 of 1%. That rupee still very soft. As I mentioned, we do have inflation data for the month of October out of India later on. The expectation is that's going to be a pretty soft read, could put some more pressure on the currency. Well, Tata Power has reported a drop of almost 1% in second quarter net income to $104 million, and that fell short of the average analyst estimate. The company also says it's studying setting up a 10 gigawatt solar ingot and wafer plant with a final decision expected in a couple of months. It's also considering possible subsidies from federal and state governments to support the project. And joining us now exclusively is Tata Power Managing Director and CEO Praveer Sinha. Praveer, thank you so much for joining us today. I just wondered if we could start by discussing some of the headlines that we mentioned coming out of your earnings announcements. I want to start with coal power, actually. If we can look backwards, you have a plan to phase out your coal power capacity by 2050, but on the other hand, the government is encouraging companies to build new coal power projects. So would you consider reversing that decision? How are you approaching that coal-powered section of your portfolio at the moment?
So we already have nearly 9 gigawatt of coal plants. And I think what is important to see is the opportunity in terms of not only short-term, but also long-term in terms of providing clean power and reliable power. We have been adding a lot of capacity in renewable energy. Our existing coal assets continue to operate very well, but we keep on examining proposals which are there because the timeline that is required to set up these plants, as also some of the government approvals and consents that have to be received, especially in terms of environment and pollution clearances. So we do look at all these opportunities. The question is that where we need to allocate money so that we get faster returns. As you have seen, our manufacturing of solar cell and modules have done exceedingly well. our investments in Odisha discoms have done exceedingly well, as well as our rooftops. So we keep on trying to balance between long term and short term. And we already have a lot of capital that is tied up to our hydro projects and pumped hydro projects and ongoing renewable capacity addition. So we will definitely examine it at the right time. We'll take a call.
I want to get to the solar side of things in just a moment, but one other question on coal. Do you think use has peaked in India yet? And when do you see coal use peaking?
I think the way the demand has been increasing in the country, there has been rethink that possibly for long-term reliability, we require coal also, along with the new capacity additions, which have actually taken place at a very fast pace for renewable. And it is basically a question of balancing act which is being done so that we do not have a scenario whereby we have power during the solar hours and wind hours, but do not have power during non-solar and non-wind hours. So I think it's a question of demand supply and what is the expectation going forward in 2030, 2035, 2040. So we need to take a very, very calibrated view on these aspects.
So in terms of the solar business that you mentioned, investment in building ingots and wafers as well, how do the margins compare on that business to some of the other power generation sectors you work in?
I think there is a great window of opportunity for the solar ingots and wafers, as we saw in solar modules and the cell. Whereby the tariff barrier, as also the requirement that everything has to be produced domestically, has kicked in. And we expect that even for wafer and ingot from 1st June 2028, we'll require 100% Indian manufactured wafer and ingots. So I think there is a great opportunity for us to get into this. We have been in manufacturing for a very long period of time. The first plant came up for cell and module in 1992. So I think considering the sophisticated nature of manufacturing that is required and our DNA of being very, very sturdy in our manufacturing, we feel that we can definitely go and set up a 10 gigawatt manufacturing and plant for wafer and ingot. We are exploring this. We still have to get few of the issues sorted out, but we do feel that this is a great opportunity for us.
Yeah, and you mentioned the rooftop solar business as well. That's growing very rapidly in India. What sort of market share are you targeting there?
So in the manufacturing, we are one of the biggest. Today in the cell manufacturing, we were first off the block. And our plant has fully stabilized, and you have seen excellent performance of our solar module and cell plant in the last quarter. And now that we have stabilized, our input prices have been controlled and efficiency gains have come, you will see a much better performance in this area going forward. So that's our mainstay, and that also gives us huge comfort in the utility scale solar projects that we do for ourselves as well as rooftop solar. So I think if you look at it in an integrated way, we are fully covered and our input prices, quality, everything is controlled. And similar benefit we expect that when we go and set up a wafer and ingot plant, we should be able to get similar type of margins and with a payback period of 3 to 4 years.
We need to talk about artificial intelligence as well, which is an extremely energy-intensive business. What's your thinking around this, and what are your plans to meet that increasing power demand?
So we work with many of the companies which are into hyperscalers as well as data centers. We have actually we supply to 7 of them. And we feel that whatever is their future demand, we'll be able to cater to that. We do that both through a combination of conventional energy as well as new energy. And we expect that 2029, 2030 onwards, we'll be possibly be in a position to give them 100% clean energy requirement and also at a very, very affordable tariff. So I think it's a great opportunity for us. We are looking at this very closely, and we feel that Tata Power will be one of the biggest partners for the hyperscalers and the data centers that will come up in the country.
And of course, nuclear energy is often pointed to as a potential solution to the insatiable power demands of AI. And I know you've been speaking about your interest in nuclear. Besides law changes, what else needs to happen in the ecosystem to make this a commercially viable and attractive business for you? And what technologies would you pursue?
So we are looking at all the technologies. We have scanned the technologies in Europe, US, as also in South Korea. And we feel that there is an opportunity to partner with some of the technology partners and technologies suppliers from these countries. We also would require to tie up the fuel for this. And again, some of these technology partners will be able to support us in arranging fuel. Because long-term fuel supply, consistency of supply, and also some sort of arrangement of costing will be very important to make the nuclear plants viable. And then we are looking at setting up in these plants in different states, for which we are in touch with the various state governments for allocation of land. So we are very much there. We are waiting to read the fine print of what changes and amendments comes in the Act. And we will be in a position to take forward as soon as we get better clarity.
All right, Praveer Sinha, MD and CEO at Tata Power, thank you so much for joining us today. And we do have more insightful conversations coming up on today's show. Eurasia Group's China Director, Dan Wang, is going to join us next for a look at the structural issues holding back China's economy. And later, the Citi Institute weighs in on the impact of AI and the future of work and finance. We have more to come in our next hour of Insight. Keep it here with us. This is Bloomberg.
Welcome back. You're watching the second hour of Insight with Haslinda Amin. I'm coming to you live from the Singapore FinTech Festival, where I just interviewed the Bank of Korea governor, who told me that policy will remain easy for now.
At this moment, given the negative output gap still, our official position is that we will maintain the easing monetary cycle, but the magnitude and timing of the cut or even the change of direction will depend on the new data that we will see.
And we'll have more from that exclusive interview with Governor Wee Chang-yong just slightly later this hour. For now, here's a look across Asian markets, with the U.S. moving closer to ending its government shutdown. Traders await a slew of delayed official economic data coming once the shutdown is lifted. But in the meantime, the focus is on private data, and the latest ADP jobs data shows more job losses in October, adding to bets for a Fed rate cut before the end of the year. For more insights on the markets, Bloomberg M Live executive editor Mark Cudmore joins us now. Mark, that soft data providing that optimism in the markets.
Well, I think there is a little bit of optimism on that Fed cut being more likely to be delivered after that data. But of course, that's a Fed easing that will become because of bad data. So it's hardly good news. The stock market in the US yesterday finished positively despite tech weakening, which is actually impressive breadth and a change from the narrative recently where most of the moves have been driven by tech. I would say that overall the price action this week, despite stock markets generally globally being higher on the week, most of them, the price action is not particularly encouraging. It seems like we're whipping about on quite minor or secondary drivers, which shows a little bit of fragility out there. And I still think that the pullback in global stocks that started 2 weeks ago is probably not exhausted yet, and we probably have a little bit more downside ahead of us over the next couple of weeks.
You got to wonder what the return of data would mean for market sentiment. What are you hearing?
So I think it's going to take a while before we trust the official data. Once we start getting these delayed releases, we know that the collection period's been distorted, base effects are messed up. We're gonna, we might get the first jobs report we get is actually the September report, which now seems out of date. It's one of these classic cases where what happens is, rather than dismissing the data, investors see what they want to see. So I think the underlying narrative is what will drive this more than the actual hard data, because the hard data can be spun another way. And with that backdrop, I think there's a general belief in the market of a K-shaped economy, so that the overall economy is doing okay, driven by capex spending by the AI sector. But the fact is that that the real economy is suffering a little bit. There is increasing cracks in the jobs market. And that combined narrative of a K economy that's superficially being held up by the AI capex spending means that there'll probably still be the pressure there for a Fed cut in December. I do think it's understandably going to be very tense because of that data confusion. People can argue vehemently either way, but I think the political pressure there is for a Fed cut, and I think that's most likely the way we're going towards in December, which again will kind of keep that easing cycle going.
And Mark, that dollar rebound, it does seem like that will likely gain momentum from here. Is there a fair assessment?
You know what, I've been in the camp for the last couple of weeks that we'd get a dollar squeeze into year end. We've seen a little bit of one, but it's been really tame so far. And I think people are beginning to lose a little bit of faith in that story that the dollar squeeze has much further to go. The positioning now is pretty flat in the short-term market, so there's less of a reason for a squeeze in the dollar. I guess for choice, because I think dollar yen can go a chunk higher, I think that can generally drive a little bit of dollar strength across the board. But I'm just not convinced the dollar is the exciting trade right now. FX hasn't been particularly exciting all year, but if you want to be an FX, there are a bunch of wonderful relative value plays. There are some really good longs in the EM space still, and there's some good shorts in things like the New Zealand dollar, Aussie dollar, that Canadian dollar that still probably have quite a bit of downside. So I think crosses are more exciting in the FX space going to year end, and I think yen still has more weakness as well.
Mark, we're also keeping an eye on the Chinese market. We saw how the Singles Day number from JD.com looks pretty encouraging. Do you think this might just play out in the Chinese market?
I'm a structural bull on the China-Hong Kong stock market. I've been in that camp probably too early. I was there probably 2 years ago before the rally started. But I think the moves made just over a year ago in September last year were really momentous, and I think they're underappreciated at the time. And we made a big song and dance. That was the messaging from the government, that they were going to make sure that the market no longer suffered inordinately relative to the economy. I think the economic story is a little bit more nuanced in terms of that. Again, I don't believe the panic mongering narrative on China's economy, but so it's better than that. But it's not going to turn into a suddenly bullish story. They're genuinely fighting a very, very deep and structural deflationary problem and a big demographic problem. And that's not going to change anytime soon. So China's going to be an ongoing economic battle, but it's better story than the panic mongers would have you believe. And I think the structural story for Chinese and Hong Kong stocks they are still discounted on a relative basis compared to US peers. I think they'll still be driven by the global narrative. So where the AI theme goes will drag them in the short term. But over the coming years, I very strongly believe Hong Kong and Chinese stocks will outperform US stocks.
Mark Cutmore, thank you for keeping my seat warm in the studio. Bloomberg MLive Executive Editor Mark Cutmore in the Lion City. Well, JD.com, as we said, says orders during this year's Singles Day shopping festival jumped nearly 60% from last year, including a surge in overseas sales. Let's bring in our China correspondent, Min Lo. And Min, positive signs from JD sales numbers, yeah?
Yeah, definitely. And as you mentioned to Mark Cutmore as well, there is this very deep structural deflationary trend that we're seeing. And that's why the JD.com numbers were pretty surprising, because it's record sales up nearly 60%. I think what the numbers don't tell us is exactly how strong the domestic sales is, because they didn't give us a full breakdown. We know that a lot of that lift is driven by its overseas push, because it's seen 100% increase, basically doubling of sales numbers when it comes to markets like Singapore, Malaysia, South Korea, Japan, Australia, and Thailand. It saw tripling of orders as well in 13 foreign markets where it offers free delivery. So that is helping to boost the numbers there. We are still waiting for Alibaba's numbers. We don't have that yet because Alibaba is extending the sales until end of this week, Friday. But we do have Xiaomi's numbers topping $4 billion in sales. Very strong numbers as well. This is the same as what we have heard from Alibaba in the initial hours of the campaign. They said in the first couple of hours, some of the top selling items were Apple's iPhone 17 and Xiaomi's 17 as well. Some of these consumer electronics doing really well. But again, competition extremely intense because Alibaba allocated 50 billion yuan in consumer vouchers to its VIP 88 members. These are the high value spenders. They typically spend 9 times more than the average spender. So they're doubling down on their support for those high value spenders and that discount game going strong among some of these e-commerce players.
Meanwhile, Min, PBOC dismissing concerns over the slowdown in loan growth as well.
That's right. We have been seeing a weakness in the credit cycle, and the PBOC released its third quarter monetary policy report and saying that this weak credit cycle is to be expected because the Chinese economy is transitioning from a high-speed growth to high-quality growth. And we are seeing as the government promotes the high-quality productive forces, they're making different types of funding available so companies can tap into venture capital, into the stock market, the bond market. They don't necessarily have to take out bank loans. At the same time, we're seeing a decline in consumer loans because of the property sector, right? A lot of that savings that used to go into property now go into the capital markets, and the government doesn't necessarily want to continue propping up property, and they want to move away from that debt-driven growth of yesteryears because of the local government debt problem. So all of that coming together, it seems like the PBOC is more tolerant of that weaker credit growth, and Goldman Sachs, for one, is pushing back their forecast of RRR and rate cuts by the PBOC to the next quarter, first quarter of 2026, because of what the PBOC is saying in its report so far.
It's really hard to square that, right, Min? I mean, banks are still issuing phantom loans to try to hit their credit targets.
Yes, and that really shows you the pressure that all these banks are facing. We're getting reports, this is based on interviews from a dozen of these bankers. They are saying that they're under pressure to hit their loan targets, right? Because the loan demand is so weak that some of these banks are issuing loans, getting consumers to take out loans and repay them immediately, with the banks covering the interest rates just to cook up those numbers. And it's an environment where, as I said earlier, the loan demand is weak. You have bad debt rising, you have NIM, the interest margins really being compressed because of low interest rates. That is one of the constraints that perhaps could be contributing to the PBOC considering to maybe push back the interest rate cuts. Certainly Goldman Sachs thinks that this is one of the constraints. You add to that, the PBOC recently resumed bond buying as well as a way to inject liquidity. That also reduces the urgency for the PBOC to cut rates as well. But the bank's certainly facing a lot of pressure there.
As always, great perspective there, Min. Bloomberg China correspondent Min Lo there. Now let's get more on the contrasting themes in China's economy with Dan Wang, China director at Eurasia Group. Dan, how are you assessing China's economy? I mean, if you take a look at what we're seeing in terms of those single day sales, I mean, that's really massive, isn't it?
Right. This is certainly a sign of stabilization, but I wouldn't go so far as saying this is a rebounding of the economy. The consumer confidence remains quite low, but the main theme this year is actually this reconciliation of the new reality of the job market weakness. And I've been visiting China about once a month, and every time I go there, you can sort of feel that the job security is a real issue. And for major industries like finance, real estate, civil servants, education, you name it, they're basically all announcing plans about some sort of layoff this year or next year. So in this context, we can't just say that this 1 month of data rebound has suggested a fundamental reversal of the consumer market.
So that consumer prices back being, in inflation territory should just be written off because deflationary pressures are entrenched. Is that what you're saying?
Exactly. So this economic model China is pursuing is in itself deflationary. So the more you invest in high tech, in modernizing the industrial base, the more cost effective the system has become, and the bigger the capacity it is to produce more things. It's across the board, industrial goods, consumer goods, you name it. So as a result, we probably will see this permanent deflationary pressure in the next 5 years, not just this 1 year. And for consumers, it's not necessarily all bad news because that means they could buy more things with the same amount of money. And for domestic e-commerce giants, they are also enjoying in a way by having the scale because there are no places for small players. They are basically the leader and the dominant power in China's retail market.
Entrenched deflation, yet the PBOC is pretty reluctant in providing support and stimulus. In fact, it says it wants patience in navigating the challenges right now. How are you reading, the tone from the PBOC?
The PBOC and the policymakers in general are getting more conservative when it comes to the short-term economic stimulus because everything we're seeing now in the policy front have to be in line with the long-term economic agenda. That is high-tech, that's industrial base, that's the competition with the U.S. And all those will take up resources from the private sector, from the consumer market. And for PBOC, even if they lower interest rate, they know that wouldn't really stimulate domestic demand. The main thing they're doing now is to defend the baseline. They want to protect the commercial banks since the NIM is already so low. They want to protect the currency. And on top of that, of course, they want to provide more support for the emerging industries and low-income consumers. But reaching those targets simultaneously is very difficult. Then they prioritize those high-tech, sexy new industries.
So forget rate cuts for the year. When might we see those triple R cuts? Perhaps first quarter?
Well, the optimistic forecast would be the first quarter next year. But even then, I wonder if they really have the appetite. The main task now is to ensure that everyone is at this unified direction to support the high-tech industry. Even for the services sector, they're servicing the industries. By lowering interest rate, it probably would only increase the risks within the financial market without providing meaningful liquidity for those targeted industries. So I think for the PBOC, maybe the best strategy is actually keeping the status quo.
Sometimes it is about the optics and just sending that message to the international community. Dan, when it comes to the PBOC downplaying concerns about new loans, what do you make of that?
The banks are under high pressure to find new demand in this economy, but it's extremely difficult. And one major constraint is actually linked to the housing market, because for China's private sector, they cannot borrow from commercial banks without a collateral. But with housing prices still going down, majority of the small producers, small business in China cannot borrow from the bank. It's not that there is no demand. It's simply because the banks will not take this kind of collateral in the housing downturn. So that created this loop, and the bank just has to issue more of the phantom loans. And for the prioritized industries, and especially those in the new energy supply chain, they could practically borrow from the bank at a nominal rate lower than 2%. And that's quite astonishing. The credit is flooded in this new energy supply chain, new material, emerging industries. But for the whole economy, there is clearly a lack of liquidity to support the private sector.
Dan, in the end, what does it mean for China's growth? What kind of GDP numbers should we be expecting?
So China has announced this new implicit target by 2030. So the GDP will reach $170 trillion. And that is implicit real GDP growth by about 5% a year. And I believe China has enough weapons in its policy tools to reach that target. And the main growth engine right now is still the export market. The overseas demand stay quite strong for China's industrial inputs and as well as the final goods. But for domestic demand, I can see this picking up of the infrastructure spending. And also, there's more local government financing of some of the long-term projects. And that include the dam, the data center, and some of the upgrade of the traditional infrastructure. So this should be sufficient to provide momentum for growth, but it doesn't mean those growths can be translated into people's income.
Dan, thank you. Dan Wang, China Director at Eurasia Group, coming to us from Singapore. Still ahead, we'll hear from Bank of Korea Governor Ri Chang-yong on policy moves and the impacts on the nation's red-hot property market.
Monetary policy alone can control the housing prices. But on the other hand, we are mindful that ample liquidity wouldn't throw the fire to the real estate market. We need to coordinate. There are a lot of government policy has to be coordinated, not in the short term, but in longer term perspectives.
Welcome back to Insight. SoftBank tumbles after its exit from Nvidia, spooking investors nervous about tech sector valuations. SoftBank sold its entire Nvidia stake for $5.83 billion to fund AI investments. Investors have been questioning the amount of capital pouring into AI with uncertain returns. Now, CoreWeave shares tumbled 16% in New York after the cloud and software provider cut its annual revenue forecast, citing a delay in fulfilling a major customer contract. CEO Michael Intrater told us how the company is working to diversify its suppliers.
That is the question that we work on across our company continuously, right? And if you think about the messages that I was trying to communicate during the earnings call yesterday, I talked about the incredible impact of the effort that we've had to diversify our clients. We started the year with 85% of our revenue to a single client, and we are coming out of the year with our backlog with which has reached all-time highs, where no specific client is more than 35% of it, and that is down from 50% even last quarter. So you're seeing tremendous progress on the contracting side. On the supply side, when you're looking at the powered shells, the data center providers, there is no single provider of data centers that represents in excess of 20% of our 2.9 gigawatts of power that we will be delivering to the market over the next 24 months. So you're seeing a real focus by our company to diversify on both sides of the ledger. The clients that we are delivering infrastructure to, as well as the suppliers that are delivering us the components that we need to be successful.
What can be done? Because we hear about power issues. We hear about how much people maybe need government to help speed up contracts, supply chain headaches. What is it in this particular data center issue that won't be replicated down the road? How are you making sure, or is it just something we are going to see time and time again, do you think?
Look, the way that we are handling this is we are doing several discrete things to ensure that we are future-proofing ourselves against these type of delays, right? So we have our team that has been built out over the past year that builds and delivers data center. And so we have a self-build organization to be able to deliver our own data centers. For instance, Kenilworth in New Jersey, or Lancaster in Pennsylvania, where we are building from the ground up. Those skill sets, being able to deploy those individuals with those talents down to the data centers as they're being constructed by third parties if they encounter problems where we can be useful, helpful, thinking through ways of solving and driving the process forward is really important to being able to mitigate these type of delays.
And that was CoreWeave CEO Michael Intrater speaking to Bloomberg Tech co-anchor Caroline Hyde. Let's take a look at how it's shaping up for the U.S. U.S. futures looking like this as investors mull the softer than expected numbers in terms of U.S. jobs data. That's strengthening bets on a Fed interest rate cut, boosting sentiment. You have it on your screen there. Futures pointing to a higher open, extending the gains we saw overnight, currently up by about 1/10 of 1%. The MSCI Asia Pac Index, of course, as you know, it's in positive territory as well. On the back of that, tech shares recovering from that initial weakness that we saw in previous days. Now, still to come, Chinese AI upstart DeepSeek issues a warning that society is about to be shaken to its core as most jobs disappear to be replaced by automation. We take a closer look next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. A senior researcher at DeepSeek has reportedly warned that a severe labor market crisis is coming as AI wipes out most jobs. The South China Morning Post says the warning at a Chinese tech convention last week was that society is about to be shaken to its core. Bloomberg Opinion columnist Catherine Torbeck has been looking into this. And Catherine, why is DeepSeek's warning about AI job losses such a huge deal?
Well, good afternoon. And yes, I think this is a huge deal for two reasons. One is that we really don't hear a lot from DeepSeek. You know, they've skipped out on most of the major tech conferences this year. And the last time we saw their CEO in public was at that February meeting with President Xi Jinping. So I think when they do step into the spotlight and issue this kind of warning, it probably is worth listening to. And second of all, you know, we've heard from a lot of Western tech leaders about future sort of labor market disruptions from AI, and especially for entry-level jobs. But in China, I think the entry-level jobs crisis is already here. You know, we've seen persistently high youth unemployment ever since the pandemic, and it's created all kinds of tensions. So I think that this issue for Beijing really, or this warning for Beijing really couldn't come at a worse time. And I think it'll be really interesting to see how they end up dealing with this.
So this AI jobpocalypse, it is clashing with Beijing's own tech ambitions, yeah?
That's right. So, you know, I almost look at it as kind of a catch-22 right now, because Beijing is really counting on AI to boost productivity and create all these sort of new growth factors. But at the same time, you know, if the technology threatens the jobs that really underpin China's consumer economy, you know, I think that's a real threat, and it's really at odds with each other. And so I think that, you know, if people can't find jobs, you know, they're less likely to spend, they're more likely to save. And that's kind of the opposite of what Beijing's trying to do right now and trying to encourage. So I think it'll be really, really difficult for policymakers right now. But I really think they need to take this sort of entry-level job crisis that we've been seeing sort of building for a while seriously, especially now, and especially before automation sort of enters the picture.
Catherine, thank you. Bloomberg Opinion columnist Catherine Torbeck there. Well, our next guest runs the Future of Finance team at Citi's Thought Leadership Unit, the Citi Institute. The team is focused on the intersection of the future of money, finance, and emerging tech, providing analysis and advice to Citi's clients and the bank's leadership. Ronit Ghose joins us now from the Singapore FinTech Festival. Ronit, good to have you with us. First off, we've been talking about how AI will change jobs, and we know that within the finance space, in banking, 54% of jobs have the potential to be changed by AI, disrupted by AI. How are you looking at?
Sure. Haslinda, the way I'd frame it is it's not 54% of jobs, it's 54% of tasks. So the nature of your job and the nature of my job has changed dramatically in the last 20 years. When I was a young analyst in London, most of my job was collecting information. Today I can go on my Bloomberg terminal or other terminals and just get all the information to my fingertips. 20 years ago, my boss, the managing director, would phone call a client and say, hey, the share price is this. No one does that anymore. So we focus on analysis, not information. And so our jobs will change. So if you're doing a job that's very basic, repetitive, and routine, your job is going to be replaced. Just like if you worked on the Apple factory floor in Shenzhen or wherever 10, 15 years ago, robots have replaced you. But new jobs will be created. Lots and lots of new jobs get created all the time. So we need to be constantly thinking about reskilling and staying open and curious. So yes, there will be challenges, but overall, I think it'll be more of an adaptation to this new technology that will not just change jobs, it'll change our lives. The way we live, the way we shop, the way we play, all of that changes.
And that's just it. AI, automation is changing the way we live, the way we shop. I mean,
Totally.
how are you looking at, the advent of stable coins, for instance? That's changing the way we do business.
Yeah, and they kind of connect. So I always use the example of, like, I'm going to fly back tonight to Dubai, where I live. I land at 1 a.m. My fridge will probably be empty. Wouldn't it be great if my fridge just ordered for me using AI? And it would probably pay with a stable coin. It would have a wallet, and it would use that wallet like a pre-approved credit line. So I think stable coins are like sending money at the speed of an email. So there'll be a lot of use of stable coins in the future. We wrote a couple of reports this year saying the stablecoin market's going to explode in size. But there'll be other payment form factors alongside stablecoins, bank tokens, and existing bank rails. And Visa, MasterCard don't go away, they still stay. But there'll just be more diversity at checkout.
Explosion. We haven't seen that. It's still quite tepid in terms of stablecoin growth.
It's growing rapidly, it's just very small. So today, the stablecoin market in issuance volumes, about 300 billion roughly. The start of the year, 9 months ago, was about 200 billion. That's not a bad growth, and the turnover at the moment is about 100x. But it's very much focused on the crypto industry. What will happen in the future with more regulation coming in Singapore, in the US in particular, larger companies, particularly e-commerce and gaming companies, will use stablecoins. In the developing world, in the frontier markets, a lot of people will use stablecoins because their rails, payment rails, don't work as well as they do in Singapore or in Dubai or London.
You talked about how this year is a Chat GPT moment. Talk to us what you mean by that.
By that I mean, ChatGPT was when AI went from being a nerdy subject in the basement that machine learning experts did to becoming a boardroom subject. Everyone in 2023 in the boardrooms, in the executive committees of banks, of companies, were talking about AI. But AI is not new. It's 70 years plus old as an academic discipline. So in the same way, in March, I wrote this report with my team saying, this is a ChatGPT moment because it's going to become a boardroom topic, and it has become a boardroom topic. That's what I meant. It's become a big public policy topic as well.
Well, the question is, how big will it be for Asia? We talk about how stablecoins heading towards 1.9 trillion by 2030. How much of that will come from Asia, and what kind of trends are you already seeing right now?
Right. So where we expect the growth in Asia, particularly the more frontier markets in Asia, so again, not a country like Singapore where you have a strong currency, but in countries where inflation is higher, currencies are weaker, people want to hold a stable coin, a dollar stable coin, as a reserve asset. A bit like people hold dollar bills. 80% of $100
so
bills.
For Asia, which of these countries are you referring to?
I'm thinking of the Philippines, the Indonesias, the Vietnams. That's where you're going to see people holding stable coins as a dollar asset. Other countries, again, where the payment system may be not working as efficiently cross-border, they'll use stablecoins for cross-border. And big e-commerce companies might use stablecoins as their in-game or in-app loyalty program token.
Where are we at for these countries right now?
Very early.
12 to 24 months, where might we be?
We're very early now in these countries in Asia, around the world. It's really a crypto industry product at the moment. In 12 to 24 months, I'm going to expect maybe in my mobility app wallet. So here I've got a Grab wallet which I use whenever I come to Singapore. Maybe there'll be a token in my Grab wallet.
Part of the issue is regulation.
Yes.
And disparate regulation at this point in time. Do you see a more coordinated approach? Do you see a standardization of regulation anytime soon to drive the growth you're anticipating?
Maybe in regions like in Europe, there's regulation called MiCA. In ASEAN, there might be collaboration and benchmarking. I'm sure the MAS will play a part. In Singapore, the rules are very much around being a payment token rather than as a speculative asset. The real focus we've looked at is the US because most stablecoins are dollar-backed. The stablecoin is linked to a dollar asset, treasury bills. So really focusing on the US regulatory framework, the Genius Act and other legislative proposals coming this year and next year, that's where the main driver is going to come from, the US regulatory system.
I'm just wondering though, as you say, it is USD backed.
Yes.
There's increasing talk about other denominated currencies like SGD backed.
Yep.
When might that be a reality? When might traction come?
Yeah, so there'll be SGD, there'll be AED backed, United Arab Emirates stable coins. The traction will really come when big companies, so I think the mobility apps, the e-commerce players, when they start embedding a stable coin into their platform. Most consumers, we care about this for our jobs because we're observers of this industry. Most consumers don't care if it's a stable coin, a deposit token, Visa, they just want to go somewhere on their taxi. They just want to do some shopping online. And the stablecoin is going to be invisible in the background. You'll pay at checkout and you'll be paying by Grab or paying by Amazon. The stablecoin will be behind. You won't even notice it's there.
Ronit, just one final question before we let you go. What's the biggest risk out there? What are you most concerned about as we push through stablecoin usage?
Yeah, I think that it's not so much a risk for stablecoins. It's more of a risk of just focusing on stablecoins, because if you're in the payment world, stablecoins are like offering one type of food. If you're a big supermarket, you need to stock all kinds of food. So you need to be able to have stablecoins at payout. You'll need to have a bank at payout. You need a Visa or MasterCard at payout, or some other form of payment. So I don't think you should just focus on one of these things. And of course, you've got to look at regulated stablecoins. In the crypto market, there are a lot of unregulated stablecoins. Where are they stable? Are they even a coin?
Ronit, thank you so much for that perspective. Ronit Ghose, head of the future of finance at Citi Institute. Now, some breaking news right here. Billion Brains Garage Ventures, parent of India's top discount broker Groww, jumping in its trading debut in Mumbai after a $749 million IPO. The stock, by the way, up as much as 21% in early trading. The IPO was subscribed more than 17 times the number of shares offered. Now, still to come, my exclusive conversation with Bank of Korea Governor Lee Chang-yong on the monetary policy outlook amid global uncertainties. Keep it here with us. This is Bloomberg. Welcome back to Insight. We're tracking Korean markets today as bets grow. That will see greater volatility in the nation's red-hot stock market. The Kospi Volatility Index has jumped to a level last seen in April when markets tumbled on President Trump's tariffs. This comes as the benchmark Kospi has gained more than 70% this year, making it the top-performing market globally. Now, Bank of Korea Governor Lee Chang-yong says he does not think Korean stocks are overvalued. He spoke to me exclusively about the volatility in the nation's markets and how the central bank is navigating global uncertainties.
From a Bank of Korea's perspective, we don't believe that the monetary policy alone can control the housing crisis. But on the other hand, we are mindful that ample liquidity wouldn't throw the fire to the real estate market. We need to coordinate. There are a lot of government policy has to be coordinated, not in the short term, but in longer term perspectives. And I think government is considering new supply policies together with many other policies. So we'll see how it's going to affect. I don't think that it's going to have a very short term impact on the price itself. But at least I hope to see the slowdown of the rapid increase of the housing price in metropolitan area.
So rate cuts are still on the table. Some say why? Because when you take a look at GDP, it's come in higher than expected, and trade looks pretty resilient.
Yes, but if you look at our growth focus at this moment, in 6 months ago, we focused that this year's growth rate is 0.9%, well below our potential GDP growth rate. and 1.6% for next year. We will have a new forecast released in 2 weeks later. And we'll see how much is going to be, there's upside potential, so how much is going to be revised. And after that, we probably have to decide how we're going to adjust our monetary policy. But at this moment, given the negative output gap still, our official position is that we will maintain the easing monetary cycle, but the magnitude and timing of the cut or even the change of direction will depend on the new data that we will see.
You talk about how growth is below potential. What is potential? Where do you hope growth will be?
Yeah, at this moment, because of the rapid aging, our potential GDP growth rate is probably in between 1.8% and 2%.
Let's take a look at the bond market because it seems to be sending a different signal, right? Yields have been surging to levels perhaps that suggest that, rate cuts are no longer needed and perhaps even a rate hike may be in the making. Is the bond market, are the bond traders misguided in thinking that?
I think there is some section of the bond market traders who believe that so. But I think at this moment, our bond market yield react not only to the domestic factors, but also global factors, such as the possibility of the U.S. Fed decision and also the dollar strength. For example, like 6 months ago, many market participants believed that dollar will be more weakened, but it looks like there is some revision of that view too. So I think that's the difficulties. Where our bond market is now reacting not only domestic factors but also international factors. So we have to consider both.
Are you concerned? Is there a need perhaps for the BOK to implement measures to rein in the yields that are surging at this point in time?
Yes, definitely, because that will affect our monetary transmission mechanism. You know that we have cut our interest rate 100 BP from last October, and we was easing cycle. But from last August, the rise of the housing prices in the metropolitan area was way above our expectation. That dominated our concerns. But now with the new government policies and the new, especially after the trade deal and the investment package was agreed with the U.S., we have to now see how much the upside moves in our economic activities too. So probably in 2 weeks later, when we see our new economic forecast, we have to revisit these issues again.
The trade deal, any thoughts on it? Was it a successful trade deal, you think? Beneficial to Korea?
I would say that it was a good development that both leaders has agreed on the trade and investment packages, which helped to reduce the bunch of the uncertainties regarding the tariff. After the summit, our working level officials refining the MOU and the fact sheets. And from Korean's perspective, in order to implement this deal, we need parliamentary approval and also the enactment of the new law. So we have to see. But I think at this moment, what is important at this moment is both United States and Korea, has to find a project which is commercially viable and also win and win for both countries. In my opinion, it will be really nice to see some joint ventures which combine the strengths of the United States, which is strengths in basic science, with the strengths of Korea, which is strengths in application and manufacturing technology.
One of the key focus has been the $350 billion investment fund in the U.S. That has been the reason cited for the weakness in the won. Negotiations have concluded, yet the won is still among the weakest currencies in Asia in the last 3 months. Why do you think that is so?
I think there are too many factors in the last 2 to 3 months which affect our exchange rate. One is the AI stock prices, volatility in AI stock prices, related stock price in the United States, which affect our stock price too. And the shutdown of the U.S. economy, which make the many data unavailable, and there is uncertainty about the U.S. Fed policy and the dollar strength, and the new Japan administration and what kind of macro policy they will do, which affect the weakness of yen and maybe the future directions. And then also, as we discussed, that agreement in the APEC summit in Gyeongju in Korea that includes the U.S.-China trade relationship and also U.S.-Korea trade and investment packages. So there are so many factors at this moment. And then I think I need to see the fog to clear before we see the new direction. But as you mentioned, I think our market, in my personal opinion, is excessively sensitive to those uncertainties.
So given the fog that you mentioned, that depreciation in the won, is that too excessive, or is that actually reflecting the fundamentals of the Korean economy?
It's very hard to judge at this moment because there are so many fundamentals are moving around, and especially the factors that I mentioned. So I need to see how this whole uncertainty will go in the future direction. But on the other hand, I say that this is not I have less concern on financial stability-wise because these days the Korean won exchange rate move was mostly dominated by the domestic investment abroad. So domestic residents has investment. So in that sense, our foreign currency debt level is actually stable, is not big, and all other indicators suggest the strength and the soundness of our market. So I'm not worried about financial stability wise, but in that sense, but on the other hand, because of the large movement of the resident portfolio, there is a volatility in the exchange rate itself, and it can be excessive, or we have to see it. Yeah.
So as it stands right now, no reason for the BOK to intervene to support the level of the Korean won?
Nice try, but I won't comment on it.
There's no fair value of the Korean currency at this point in time?
We see the volatility, and when we see the excessive movement, we are willing to intervene.
Some say the excessive movement is actually seen in the stock market.
Yeah.
The Kospi in excess of 70%. Is there reason to be concerned about the surge in the stock market in Korea?
No, if you look at our price per earning and or the PBR, or price book ratio, even with the heightened increase of stock prices, still our PR is 1.1, well below the other countries' level. So overall, I don't think that our stock is overvalued that much compared with other countries. But having said that, definitely the recent increase of our stock prices led by the high tech, especially semiconductor industries. Definitely there is a good news that semiconductor is doing much better than what we have expected. But on the other hand, our stock prices in semiconductor won't be free from the stock prices of technology stocks in the United States. So volatility will continue.
Are there hidden risks? Because as we talk about how the markets are driven mainly by the AI theme, if we see an unraveling, that could be a lot of pain, especially for domestic retail investors in Korea.
Actually, that was a hot topic when I was in BIS last week, and how much the stock price generally, especially in this Magnificent Seven or the high technology stock price has overstretched. So it's going to be very hard. There's a lot of discussions. It will be very hard to know which view is correct. But I'm a little bit, relatively speaking, I'm a little bit optimistic and less concerned. Because if you look at in Korea, in AI sector, for example, Korea is very strong in hardware as well as software. So there is a lot of discussion who's going to be a winner in AI competition. But whether this is OpenAI or the Google, all these things. But whoever the winner, and it won't change the demand for the hardware, for example, semiconductors.
And that was Bank of Korea Governor Ri Chang-yong. Of course, we have the Kospi in the positive, but the won extending some of those weakness, showing some continued weakness down for a second day. We know that it has to do with foreign selling. We're also keeping an eye, by the way, on the Indonesian rupiah, which is weaker as Bank Indonesia sees room for rate cuts, expansionary stance in 2026. It sees the currency averaging 16,430 per dollar next year. And it says it is committed to rupiah stabilization measures as well as intervention. That is it for Insights. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.